Good afternoon, everybody. We've got a few more folks registered, so we'll give them a minute or two because I'm sure they're just biting at the bit to hear what I have to say. Oh, look at there. Sharon, are you doing the admitting?
I am.
Terrific. Better you than me.
There you go.
Well, let's go ahead and get started, everybody. If there's some laggards, they can join in and we'll bring them up to speed on the exciting things that we're talking about here. As I was getting ready for this briefing, I thought, it's 5:30 and we're probably going to have to send out wine in the future to people who are going to go through this thing because it's 5 o'clock somewhere, right?
That's right.
Welcome, everybody. We're glad that you're here. We're pleased that you're here. These are becoming more and more fun because we have learned Zoom, I guess, like everybody else has. Take your mute off, all those sort of things that we've all been through. We hope you're healthy and safe. It looks like there's a little sunshine in our world. There's certainly some sunshine in Augusta, Georgia, thank goodness. And it looks like there's some sunshine on the COVID front based on vaccines that are coming out and so forth. So we'll touch on that a little bit here in a second. But as always, I'm joined by our team, many of our team members at AP Wealth, and Sharon is running the technical aspect of this from our world headquarters in Augusta, Georgia. And as always, I'll ask Sharon just to briefly give us an overview on how to ask questions and some technical issues. Sharon?
Awesome. Okay. We would love to have questions from you as we go along. You can go to your toolbar that's either the bottom of your screen, could be the top, depending on what kind of device you're on, and go to the chat box and you can send a question to the entire group or just to me, however you would like to do that. And we'll get those answered to the best of our ability. And if you have any problems with anything, you can, call the office or, send me a message some way to help you resolve those. Anyway, thanks for joining us.
Thank you, Sharon. Don't be afraid to ask a question. As your teacher always said, if you've got that question, probably everybody else does too. There's no such thing as a stupid question. So please ask. We're also joined by some other team members here. I see Clayton Kwame, who is on with us, and I think some other folks are going to join. So as always, Clayton and Sharon, hop in if you got a thought, or you can answer a question or bring another perspective, because I certainly don't have a corner on good ideas, as y'all know. So today we're going to do a market update. And I'd like to just close the book and say we're in a great spot and let's just move forward. And we are in a great spot, but there's probably some things that we ought to talk about. So let me pull up my, let me share my screen with you here and get my ugly face off of here. And so today we're going to do a financial market update, what's going on, and I'll sort of take you through it. Before we do that, as always, here's our approach to investment management. At the top of our triangle to the right is always asset allocation. That's what provides the most value. And of course, asset allocation is based on your time horizon and your risk tolerance. And way down at the bottom is security selection or trying to pick stocks. So value at the top, least value at the bottom. And then, as always, to our left, our total return is always income plus capital appreciation. We can control income because we know what dividends and various investments are going to pay. We cannot control capital appreciation because we don't know what's going to happen. And over to the right is our efficient frontier with return on the left axis and risk on the bottom axis. And we want to place all of our clients on the efficient frontier to maximize return and reduce risk. So what we're going to talk about today are 4 basic topics with regard to the financial markets. Where have we been? Where are we now? Where are we going? And then I've got a story about Ant in China that I think is relative to what's going on. So where have we been? It's been a crazy ride. COVID has certainly caused a historic downturn. COVID has also caused a historic recovery. This graph that I've got in front of you, don't pay attention to the gray or the noise in particular. Those are all downturns and recoveries since 1961. So you can see if you just look at the gray there, there's been absolutely nothing like what we've seen in the red. The red is what's happened since about February 19th of 2020. So you can see the downturn when COVID really hit us hard, but then this recovery, this from left to right uphill climb is like nothing we've ever seen before. So really we are in very much uncharted waters here from a standpoint of how do we get a game plan for this, or what do we do? So we just need to keep that in mind that we know long term what's going to happen, but in the short run, we've not been here before. So where are we now? These are sectors going from left to right and how they've performed over the last year. You can see the sectors in the recovery. So the blue is basically our whole pandemic from about March 23rd, 2020 till yesterday. And then November till yesterday, September till yesterday, and then this calendar year. What was really surprising to me about this was that energy leads the way. So since COVID really came upon us, energy is up 100%. And if you move down to the right, we always heard about info and tech and how they've done really well. Well, they have done really well. However, they've been beat out by materials and energy. But you can see the recovery is just breathtaking almost in the last year. Energy, materials, tech, going from left to right, industrials, consumer discretionary, consumer services, healthcare, real estate, and finally, utilities. So the problem with, we all look at these and go, oh yeah, we knew it was going to recover. That was not a problem. But of course, when we're in the throes of a bear market correction and in the throes of a pandemic, it's really difficult to try to determine what's going to happen. So I thought that was interesting, and I thought where we are now, we've seen a great recovery and actually higher than we were at this time last year. I just saw something I'll add to as I was getting ready to come on. We're going to talk about interest rates. And the Fed is not worried about interest rates. And I'll go to my next slide here, because as you know, when we're on these, we talk about interest rates on a regular basis and how they affect our decision making from an investment standpoint, because it does affect yields on, of course, treasuries and on competition, which would be things like stocks. So interest rates have risen. They're now yielding, the 10-year US Treasury is now yielding 1.4%. About 6 months ago, it was yielding 0.6%. So the US Treasury has really, on a relative standpoint, been really, excuse me, sorry that y'all, I got to try, there we go, has really, really moved up in the last few months or so. Earnings are improving and stimulus funds should bode well for growth in 2021 and 2022. That should say 2021, that's a typo. But as you know, stimulus funds have been a big talk politically, and some more stimulus funds will come, and that will be good. The vaccine rollout should improve and should certainly bode well for consumer confidence. For those of you who have been on this call before, our GDP, or gross domestic product, or growth of the economy, that's really all GDP is growth of the economy, is very much almost 2/3 directly affected by consumer confidence and consumer spending. So you can almost feel, we were talking earlier today, as you go to restaurants, The restaurants are starting to get more full. One of our partners today went out to play golf and he couldn't get a tee time. He couldn't get on the course because so many people were out playing golf. So there's this sense that we're beginning to roll out of this. How quickly we do will certainly determine what kind of recovery we have. The next point is our current price to equity ratio is historically high, but should normalize with improved earnings. So as you may recall, the PE ratio, or price to equity ratio, is the price of a stock with its underlying equity. And how is it doing? It's usually a measure of how healthy a stock is. That's at about 33 to 34% on the S&P 500, which is historically incredibly high. But as we see earnings, I'm sorry, that should be earnings, not equity. As we see earnings increase, that should improve going forward, and that really doesn't trouble us right now. We're going to have me check these a little bit better moving forward. And I wanted to address day traders. We've all heard about GameStop and American Movie and so forth, and GameStop had a big day today. That is all noise and will fade as usual. What's probably going to happen is the SEC is going to get involved and make sure that the financial markets run as they were intended to and not affected by day traders and anyone else who could move the markets when they are in historical crazy times. All right, so where are we going? This is a look at some predictions from the conference board. Of course, the gray to your left shows where we are through December 31st, and then some projections over to the right. You can see our base is 100, which is where we started in March. And so are we going to have an upside, downside? All of these are certainly moving up except a downside forecast, but we believe probably the base forecast, which is illustrated by the black line, is likely what we're in for. Not anything crazy, but some steady growth. And again, we think there's probably a lot of pent-up demand out there that we'll see moving forward. Okay, I want to tell you a story about Ant in China that does relate to what's going on. And this is really a story about risk. And for those of you who don't follow Ant, it is an offshoot of Alibaba. Alibaba is the Amazon equivalent in China. And so a guy named Jack Ma leads Alibaba in China. Think of Jeff Bezos of Amazon when you think of Alibaba. And so Alibaba has become so big and so popular in China, but also in the Far East, that they formed another company called Ant to allow people to pay for purchases on Alibaba. And for those of you familiar with eBay and PayPal, eBay, of course, we're all familiar with. PayPal was a result and created by eBay to allow folks to pay confidentially and securely for their purchases on eBay. Well, as Ant grew, Ant became almost a currency, and it became the primary digital pay service for over 1 billion people in China. It became so big that it became a direct threat to the Bank of China. And actually, people were using Ant as a bank and was siphoning off customers of Chinese banks. Ant got so big that it formed its own money market fund and also formed its own low-risk mutual fund. So why is all of this so important? Well, on or about November 1st, and there was a build-up to it, Ant was going to be an initial public offering, and it was going to be the biggest initial public offering ever. As many of you may or may not know, it was scuttled. The IPO was scuttled by the Chinese government. And the reason it was scuttled is because they were in direct competition to banks and the government could not control what Ant was doing. By way of example, people would take their Ant app with them and go pay at restaurants with their Ant app rather than using their debit card or some sort of card that went through the banking system in China. So the point of all this is, we talk about China. China is a communist country and is certainly a large economy, but it does not operate as a democracy. Although when we look at the financial news, it's often portrayed as such. We talk about China this, China that, how big it is. And just as an aside, we like exposure to China, but we like the United States and its investments more than we like China. China is an emerging market economy. It is not a developed economy like the United States. People are still cooking on open fires in certain parts of China. It just happens to be the second largest economy in the world, and it's second by a long shot, a very long shot. So the point of all this is, and here's a good graph, China is the only major economy to grow in 2020. So when we compare China to the United States, the United Kingdom, or Europe, or emerging markets, it's the only one that's done pretty well. So you're probably scratching your head and saying, Gene, you just said that it's a communist country. Why is it growing? Well, one of the reasons it's growing is because it's a communist country, and the communists and the party leaders can control the economy much more so than we can here in the United States and other places. But the rebound in China is due in large part to low wages, much, much, much lower than the United States and other developed countries. And that's why whenever you pick something up, it says made in China, because they can manufacture it so much cheaper there because of the low wages. Additionally, taxes are much lower in China, which is frictional for producing things. There's a strong network of suppliers due to the size of China. When you have as many people in China as you do, then your ability to produce goods, particularly as we talked about previously, PPE and so forth, it's easy to do. But probably the most important part of this whole thing is the governmental economic support and the reduction of regulatory burdens. We in the United States had stimulus put into our economy, as did the Chinese, but the Chinese also really, really relaxed all their regulatory burdens from manufacturing, from environmental, from all sorts of things that allowed China to really grow and grow very quickly. This is anecdotal, but we suspect that that was probably done because they were scared about retribution and the coronavirus starting in China in the first place. I'm fascinated by the story of Jack Ma and Ant and Alibaba, but the reason we say this and the reason I pulled this out and wanted to talk about it is because risk is everywhere. Risk is in every single investment we have, including China. What our job is, and what is most important for clients and future clients, because I know we have both on this call, is measuring that risk. So as I mentioned earlier, China is often painted as a developed economy. It's over there rolling along, manufacturing, doing great things. But as you can see from my talk here and from the points I brought up, there's a lot of risk there. There's nothing saying that all of a sudden China couldn't shut down. So the point of all this is risk is everywhere, and China is just a great example of risk that sometimes we may not recognize. So a couple of other things as we begin to wrap up and take your very good questions. We continue to monitor a couple things moving forward. Certainly interest rates, as I mentioned before, interest rates are moving north pretty rapidly, but it doesn't concern us yet, and inflation doesn't concern us yet. But what we really are keeping our eye on are increasing income tax rates and estate tax rates. When Biden was running for office, one of the things he talked about was increasing taxes on the upper middle class and the wealthy. Part of that also is estate taxes. Many folks are not subject to the estate tax now because it's each person gets $11.2 million exemption. So far and away, most people are not subject to that. But if that's pulled back down to 3.5 million per person, which has been talked about many times, when you look at life insurance, home ownership, retirement plans, and how that's owned, it certainly becomes something that we want to begin and be sure we're paying attention to. So with that, I will take us through just a quick overview of our planning process, which most of you are familiar with. This is the Lifetime Financial Solution. This is an opportunity for us to do a little marketing. And also how we take the complete approach when we do our financial planning and our investment management. You can see from this wheel here, we like to pull in a whole lot of other folks and a whole lot of other topics. So Sharon,
Yes,
do we have any questions?
I don't see any yet.
Okay. We'll let you bashful folks have a second or two.
I have a question, Gene.
Yeah, yeah.
So if there was a uninvested cash at this point, with what's going on in the market and what you anticipate, what do you think would be a smart thing to do with that?
Well, Brock, I'm going to give you a real general answer, and then I'll try and be more direct. It depends on your risk tolerance and your time horizon. If you were 23 years old and you had a long-term time horizon, put that cash to work and be super aggressive with it, because as I mentioned earlier, we don't know what's going to happen in the short term because we haven't been here before, but we know in the long term, stocks are going to outperform fixed income and bonds. So, and I'll go to the other end. We had a client in the other day who asked us that same question. And I said, what's the money for? And they said, well, in the next year or two, we're going to do an addition or do some sort of renovations. In that case, you wouldn't want to risk the money in the markets or anywhere else. You'd want to just be conservative and be really tight with the money and probably put it in cash. Does that help?
It does.
Okay.
Thank you. Mm-hmm.
Yeah. I'll piggyback on that. There are a few pockets that are undervalued. And in our investment policy committee meeting, we talked about transportation, particularly airfare, airlines, travel, consumer discretionary things that have really been hit hard. Those are going to come back, there's no doubt. The question is, to you, Brock, and everybody else, we can't tell you when.
Mm-hmm. So I know that you and Clayton can help me with this, but remind me, when we talk about cash, would that be like a money market fund that you could do for me, or I could do on my own, or a bank account, or what are some other things that are like cash as far as a way to put some money?
Great question, and thanks for the clarification. Cash would be money market, savings, checking. You wouldn't want to go, it's not worth it to go buy CDs now. So cash is literally the simplest forms of savings, checking, and money market. Something you can put your hands on very quickly the next day without any variations in valuations going up and down.
Thank you.
You betcha.
We do have a couple of questions, Gene. The first one is, how are we not in an asset bubble? Interest rates are negative. All good news priced in the market.
We very well could be in a asset bubble, but one of the things that's gotten us here is low interest rates, super low interest rates, still historically low interest rates. So as I mentioned earlier today in the briefing, you might get 1.4% rounding on a 10-year treasury bond. So for 10 years, you'd accept a 1.4% return. You're certainly going to go to equities where you could go get a utility and probably make 3.5%. That's been a tailwind for it. So to answer your question, we could be in a bubble, but I think that question's going to be answered. And I think it's going to be answered positively as we see earnings reports in the next 2, 3 to 4 months, because certainly the market is pricing in, the equity market or stock market is pricing in a rebound. And that's why multiples, I referenced the price earnings, not the price equity ratio earlier. That's why that's so high. The market feels like we're going to recover from this. Good question.
Okay, and our next question is, we received a PPP loan and it was forgiven. Do we need to apply to the next PPP loan, and what are the requirements?
Sharon, I'm going to put that one in your court, if that's okay.
Yeah, sure. My understanding is we can get you those parameters, but they are more stringent than the first round was. So a lot of people don't qualify that did the first time, but I'll be happy to send you those qualifications. Okay, and then we had another question that came in, and it said, what happened with the GameStop situation?
I'll do my best. So GameStop was what's called a short squeeze. And so people who are basically having fun, not taking a lot of money, will go short a stock. And when you short a stock, you are promising to buy the stock at a different price. If the price goes down, you're in big trouble. If the price goes up, you could benefit from it. And so without getting too complex, that buying in options, you've probably all heard of options. Options can make that variation much more severe. And that's what's happened with GameStop. And they've also done it with AMC, and they've looked at marijuana stocks, the cannabis stocks as well. But as I mentioned earlier, that's a great question. Even I wish I could give you the real detailed answer, but you'd either be asleep or it'd be dark outside by the time I got finished. But the SEC is certainly going to come in and do some things to begin to try to curb that. And of course, they've already had Robinhood and some other folks up on the Hill testifying to that effect.
Okay, and one more question. Historical PE ratio is 15.7, the mean. We will be at 30 times, even with earnings normalized this year, most likely. Understand, Tina, to equity tailwinds, but have we just as a society agreed that rates will be low forever?
Another good question. We have been saying that rates are going to go up for the last 10 years. And those of you who are clients of ours said, they've got to go up, they've got to go up. Well, they've gone up recently, and they went up, if y'all remember the taper tantrum in December of 18, interest rates went up only to come straight back down. Certainly interest rates are going to normalize, but what'll happen, what normal will be, we think about normal 10-year treasury as a 3.5% to 4.5% historical average. And as I mentioned earlier, we're at 1.4%. So we've got a long way to go. I wish I could say that 30 is too high, but that would be assuming that I knew what earnings would be and what growth rates would be coming forward. They may be fabulous. I just can't say. But there's a whole lot of folks who are really confident, rightly or wrongly, in earnings improving substantially and interest rates not going up. The Federal Reserve is confident. They put out a bulletin today saying we're not worried about interest rates, which is kind of surprising. Good questions. Smart clients.
Yeah.
And smart future clients. Well, while you're percolating your questions, one of the topics for our next briefing is going to be black swans. As always, we want y'all to suggest what we ought to do. And of course, a black swan is one in the 1600s. They didn't think a black swan existed. In the 1700s, I think it was somewhere in France, someone finally found a black swan. Well, certainly the COVID pandemic and what's happened is a black swan. And we'll touch on some of those financially and otherwise next month. It's things you can't prepare for. You just have no idea. And to the previous question, that's part of the quandary is, as I mentioned when we got started, we've never been here before. We've never seen a dip like this and a recovery like this. So what we try to do is stick with the fundamentals, stick with the things that we know, and not go too far out on a limb one way or another. Clayton, Sharon, what did I leave off?
I think you've done good, Gene.
Yeah.
Should we hedge inflation since it should be cheap and based on low rates now? We are a big believer in taking advantage of low rates, particularly for debt purposes. If you can fixed debt at these low rates, it certainly makes sense. You're arbitraging inflation. We've been thinking that there would be inflation for a very, very, very long time. The Fed has been trying to create inflation. They've been trying everything they possibly can to create inflation, and they've not been able to do it, even before COVID. Well, guys, as always, I bring back Jimmy Carter. Yeah, and 17% interest rates. Some of these people are too young to even know who Jimmy Carter is. As always, we're very grateful for your attendance. We're very grateful for your business and your trust and your confidence that you placed in us. If something pops into your head, please reach out to us. We're happy to chat offline about any of these concerns. We try to keep this simpler rather than more complicated, but we're nerds at heart, and I'll apologize in advance for if we got off the rails and got too complicated, but we want to be a resource for you. So everybody wash your hands, still mask up. If you can get the shot, but please take care of yourself and others. And again, reach out to us if we can be of any help, or if this stuff can benefit for some folks that might need some of our help. Of course, we'd be happy to pass it along.